And in this video, I'm going to show you how to become an investor in business. Coming right up. Hi, this is John Lee, the author of Business Hack. If this is the first time you come across me and you want to learn more about multiple streams of income, starting businesses, growing businesses, then make sure you hit the subscribe button, turn on bell notifications so you don't miss out on all the new content. So the first thing you got to understand when you become an investor in a business is to come up with a business plan, right? Or look at business plans, be able to read business plans. One of the ways I look at business plans is I'm going to know, okay, has this company sold anything before? How much have they sold? On year, do they increase? And if they do, why? If they decrease, why? And by the way, just because a company's not making money doesn't mean you should not invest in that company, because maybe sometimes they're going through what we call a transition. Sometimes they're going through maybe a listing. Sometimes they have a product that's become obsolete. So you want to think about what business plans can actually become profitable. So the best business plans are actually the ones that I see are the recurring ones. Let's say you have a company that has 1,000 people paying $10 a month, so it's got a recurring income. So by next year, they'll have another 1,000 people. Now they have 2,000 people paying say $5 or $10 a month. So what you do is you take that business plan and you extrapolate it to see, okay, 5 years from now, if that company carries on doing what it's doing, then it'll end up with this much revenue. So that's a really good way to look at companies and see, I always look for three things when I'm investing. Can they market? Can they sell? Can they scale? Right? So can they market? Can they sell? Can they scale? If they can do that, then I'll definitely invest in that company. Okay, the second thing you want to think about is you want to calculate the downside risk. So let's say, for example, in that previous example, that company does year on year over the next 5 or 10 years, and they still keep getting that recurring revenue. Well, what happens if, let's say, a year it drops by 10%? Or by year 5, it drops by 20%. So you want to calculate the overall profit when you're doing that business plan. So you've got to be prudent, right? A lot of people are very optimistic and they'll overshoot, right? And they'll never hit that target. What you want to do is be prudent. Let's say that company does this, right? You want to kind of hover around, just be a little bit more conservative, because it's better to under promise and over deliver. So when you're building your business plan, you need to put into there some kind of, skepticism as well, to be devil's advocate and say, hold on a second, what happens if this happens? What happens if this happens? Build that into the model so you're taking care of any downsides that happen. Because in business, it's never always smooth sailing. People think it's like a straight line like this, but it's more like zzz, like this, and then it kind of goes there. If you know what I'm talking about, type in yes below so you know exactly how this works. Definitely focus on the downside risk and look at what's the worst that could happen. And if you can recover from that and you're happy with that, then go with it. Okay, the third thing is you really got to look at the taxes. So for example, if you're going to invest in companies, you've got to know what tax incentives are out there. And all around the world, there are different tax incentives. For example, in the UK, if you are a UK taxpayer, one of the things that you can do something called EIS. EIS stands for Enterprise Investment Scheme, right? Enterprise Investment Scheme, so EIS. So let's say, for example, right now, you're already paying tax. You're already paying that to the tax man anyway. What if we could take some of that tax money and put it into an investment and not have to pay the tax? That's what EIS allows you to do. But obviously, to invest in an EIS company, a company needs to be EIS approved. So by the way, if you want to know some more information about that, leave a comment below with EIS and I will reply with that with some examples. A lot of people don't know this. Go, oh my God, John, I've been paying all this money to this tax people all the time. Imagine if you've taken some of that money that you were going to pay in tax, you take part of that money, and it's 30% currently. You take 30% of that and you could put it into a company like Apple or like, I'm using it as an example, but imagine if you did. Imagine after all the years, year on year, you could actually start earning money by investing without having to pay all your tax. You still got to pay some tax, but you can offset a lot of that to investment. So it's kind of like, well, I'm going to pay tax anyway, so why don't I take a portion of that and put it into a company and then grow that company? So a lot of you watching this, if you find that useful, by the way, type in useful below. And by the way, it's really good to have interaction, even though this is on YouTube. I love to talk like I'm talking to an audience. So if you could participate, I'd really appreciate that. So make sure you check out some of the tax incentives. All around the world, they'll have different tax incentives for investing in businesses or companies. The fourth thing you want to consider is, okay, if you invest in a business, don't expect the money to come straight away. A lot of people go, oh, I want to invest this much in this much company. I'm going to get $1 million. No, it doesn't work like that. Like business, you could be looking at 5 or 10 years before you see a return. So I want you to think of investing in businesses a little bit like a marathon. Like you got to run a marathon. It's not a sprint. It's like a long-term thing. So if you think about companies that you want to invest in, like just think about, okay, 10 years from now, where would you see that company, right? What are the plans for that company 10 years from now? Right? And if they've got some really exciting stuff, then maybe you want to consider investing in that business. Sometimes you might invest, and also as well, I just want to be very clear here. It's not always just investing with your money, but you could also invest with your time. You could also invest with your expertise. I know people who started off as an employee in that company, giving their time, then they got shares in that company, and those shares grew. Like if you look at all the PAs that started in the Google times right at the start, they probably make more money than the CEOs today, right? Because they're owning stock and shares in that company, and they're investing in that company, not just with their money always, but with time and also expertise. For example, I invest in companies not always with money, but I invest with my advisory role. So I'll go into a company as an advisor, and then I'll lift that profit company. So let's say the company's doing like $1 million, and then it goes to 2 million. I say, look, anything over what you're earning right now, I'll come in for free with my time, but I want some equity in that company. I'm going to take some of the profit of anything above $1 million. So for example, that's one thing that you could do as well. The fifth thing you want to think about, don't invest in something that you can't afford. Like I see a lot of people, they go, oh, this is my last dime. I just inherited this much money, and they want to put that money into something. And what happens? The company goes, then they lose everything. So I recommend, I actually have a video called Piggies, and you should, maybe I'll link it here in the description. Piggies system is, PIGES. You probably heard me talk about this in other videos. Play, invest, give, educate, and save. That's what it stands for. So I have this whole system where you actually use your money to save money or invest money, because if that investment fund disappears, doesn't matter, because guess what? You still have the other buckets or the other funds left to help support you. So try not to invest in a company and put all your eggs into one basket. You want to spread that risk so you have multiple streams of income. Okay, the last thing you want to do, this one's really important, especially when it comes to investing in businesses. And I'll tell you that in a second. Again, if you love this, hit the like button, give me a like, because that'll tell YouTube that you want to see more of my videos. Also, if you want to, don't miss all the new videos that I create, hit the subscribe button, turn on bell notifications so you don't miss out on all the new content. So the last part is you got to plan to get the money out. So when you invest in a company, so again, you can invest with your stock, you can invest in your shares. Let's say you're going in as equity. So you're going in with your time. You can say, okay, when the company hits a certain amount of money, then you want a payout of X, Y, Z. Well, let's say the share price you invest in a company goes to X share price, you want to exit, right? If you can. Some companies will pay a dividend. So, you can put the money into the company, that the profit will pay you money as well. So there's lots of things that you can do, but just make sure that, you've got a plan, because ultimately you want to carry on investing, right? You want to put it into things, especially you don't want to put the money in the bank. The bank is the worst place you can put your money, because why? Interest rates, like what's the interest rate right now? Leave a comment below if you know what the current interest rates are right now for your bank. Leave a comment below and I'll come in and I'll see what the comments are like. But I'll tell you that best place to put your money is either in yourself or in a business, because if that business takes off, bang, you got a good ROI. Of course, it could do the opposite, it could tank. So that's why you want to spread, that's what VCs do, don't they? They take the money, they put it into all these companies, they get a few winners, and the winners outweigh all the losses, right? So this is the mindset you want to start thinking about. So I really hope you found this useful. My question for you is, which of these strategies will you use? Leave a comment below, let me know and why. And if you have any questions at all whatsoever, leave the question below. I'll personally come in and answer those questions. I'll give you my 2 cents. And again, what I'll do is I'll link a video here and here, and I'll put a subscribe button up here. Make sure you subscribe, turn on bell notifications so you don't miss out on the new content. It's John Lee, the author of Business Hack. I'll see you next video.